June 10th, 2024. We got actually a really interesting pattern today. We got a reversal that was exactly up from yesterday's low. And whenever you get something like that, it increases the odds of an inside day. You can see that the day overall, when we got the gap down, it's a pretty big day yesterday. So, if we do end up getting the reversal up, it's probably not going to go above yesterday's high. And you know that we're going to really try hard, or once we start to get the reversal up, traders are going to try not to let it get back below yesterday's low or get below yesterday's low. So when you get this reversal up, it increases the odds of an inside day. I think the big problem with buying, was bar 4 because it wasn't a very strong bar. It ended up being a bear bar, and bulls wanted a good bull bar closing near its high to buy above. Bar 1, so we got a gap down, and bar 1 has a big tail on the bottom and a tail on the top. It's really not an ideal bar. Bulls see a bear trap on the gap down, and they want a big reversal up, reversing up from around yesterday's open, which was a really big bear bar. And you know that that's going to be a magnet. So yesterday's bar 1 is going to end up being a magnet. There is also an FOMC meeting on Wednesday. So traders, generally the market goes more sideways rather than up or down headed into FOMC meetings. And a lot of times FOMC meetings cause really big moves. And you can look at the daily chart. And what's either going to happen, or a lot of times what either happens, is we get a really big surprise to the up or a big surprise to the down. All the way up here, I'm not as convinced. We definitely still get the surprise up because it is always in long, but it's really not all that great always in long. We're really high in what's probably a developing trading range. Bar 2, an inside bar, a bear bar closing near its low. It's a possible high of the day, bar 1, but it's probably better to wait and see what we get. Breakout below bar 2 is really not a very high probability sell for a possible high of the day. A doji bar 3, which is relatively expected. If you sold below 2, you knew you were probably going to be disappointed, and you can see that you were disappointed on bar 3. If you take a sell like bar 2, something where it's probably not the high of the day, you want to see really fast follow through. So you want to see something like this as your follow through, and us basically collapse down to a new low. And you're just really not getting that on bar 3. Bar 4, you can see bar 3 was you're not going to want to sell below a bull doji bar. So a lot of traders, what they do instead is they end up exiting their shorts below bar 3, and some bulls will buy below. And you can see we got the reversal up. So bar 4, double bottom, double bottom 3, 4, micro double bottom, I suppose, maybe a wedge 1, 3, 4, or maybe some sort of bigger wedge, maybe over here, something like that. You draw with probably a couple of these different lines, but I think this low is the important one, showing that it was possible maybe it's this wedge with an overshoot. I think either of those is fine. But the point is, we're probably going to get some sort of bounce and a couple legs sideways to up. If we were going to go to the downside, we probably would have already started to race down. Also, I'm not, this might be a bit of a shorter video. I was really sick this weekend, so I'm not sure how good today's video is going to be, and tomorrow's video might not be all that great either. I'm just trying to, they're good to study with and build, so I'm going to keep doing them, but I'm not sure how the quality is going to be for the next day or two, so just keep that in mind. Bar 5, a bull bar closing near its high. Good for the bulls, but I'm not really sure how much higher we're going with bar 4 as the signal bar. We might need to pull back a little bit more. However, it being a reversal up from right at yesterday's low, I think is really important. Something I had my eye on was this gap. You can see the bulls who buy below this bull bar probably are going to make money, right? Even if they scale in. So the bullet traders, they're buying below here, and then we got a gap down, so they're trapped. So unless this is a bear trend, which it's probably not, it's probably going to end up being some sort of trading range. And when you're expecting a trading range, you would expect gaps to close and for us to get back to this low most likely, or this low most likely. Additionally, bears could look at this whole thing as a spike down, and then we got a pullback, and now we're getting a channel down. So spike, pullback, channel, probably also some sort of big leg 1, leg 2, I would imagine. Look at that, I got my first try. So you can see the spike down, and then the big leg 2. So the channel ended up being the same length as the spike. So big leg 1, leg 2, or you could look at it as spike and channel. Either way, you know that this is a magnet up here, because this is, well, the way I looked at it was the spike and channel, and this is the top of the channel. So it could be, both things are true, that it's a leg 1, leg 2 and a spike and channel. But I thought that the top of this channel was going to end up being a magnet, because the tops of channels are magnets and the bottoms of channels are magnets. always. So you can see it here, even, this whole thing ended up being a channel up and we tested back down. We got a spike here and then the whole channel started here. So this whole thing was a channel from this early spike. You can see we tested back the low of it over here. So channels are definitely going to be important. 6, a bull bar, but a tail on the top and a tail on the bottom. It's not as good as it could be. I'm not really sure if we're always in long. We might be, but if we are, it's not really all that great always in long. It's just barely always in long. Follow through for the bulls on bar 7. I would say at this point we are probably always in long. And you know that some bulls will buy the close of 7, knowing that we're probably going to get what they want to see is a bar like 8, what they got, where you get a quick bounce to close the gap, and then they can scalp out of their trade and make a painless couple of points. Alternatively, though, sometimes what they have to do instead is if you're buying the close 8, some traders might end up scaling in a bit lower if we start to go against them, betting that this is not going to be a bear trend. And it's probably not a bear trend because 6, 7, and 8 are rather strong, or 5, 6, and 7 are rather strong. As a spike, it's the strongest move we've seen so far today. So they're betting on either a bull trend or a trading range, buying above bar 7. Bar 8, a follow through bar, but it's climactic. You can see it was a bounce right back to the closing, or right back to that low of that spike. So over here, we bounced right back to the low on bar 8, and that's why we found sellers there on bar 9. So additionally, when you look at bar 8, it's really a climactic move, right? You can see we have some sort of channel line here, and then we get the biggest, best looking bar on 8. So it's not really as much of a buy the close bar. It's also near the moving average from yesterday's close as well. So I would probably wait to see if 9 is another big bull bar closing near its high before taking any sort of buy. You can see buyers below 8 during 9. Not unexpected, but you also have to keep in mind that 9 might end up being big enough for its own second leg sideways to down. Surprisingly, today, the traders did not get a very clear second leg sideways to down. So I thought that, 10, we got actually a lot of IOI patterns today, which is just a breakout mode pattern, but 10 is the first one of them. So an inside bar, or 8 is inside of 9, and 10 is inside of 9. So it's an IOI. It's a credible buy above 10, but it's a swing trade. You're not buying above 10 expecting that you're going to get, you're buying above 10 expecting to lose money. Basically, if you're buying above trades like 10, your goal is that today is going to be a bull trend day. You know it probably won't be, but that's your premise. You can't buy above 10 hoping to make a quick scalp. And if you're taking the buy, I think one of the glaring problems with it is that you can see the traders who bought the close of 8. Think about if you had bought the close of 8, how do you feel about 9? You're disappointed. So if you're buying the close of 10, you're betting that the traders, if you're buying above 10, you're betting that the traders who bought the close of 8 are not disappointed with 9. And they're going to stay in the trade as 10 rallies up to the 8 close. So that's not a very high probability bet. Hence, 10 is not a very high probability trade. And you know that 9 probably should get a second leg sideways to down. Bulls do have a small open gap here, but I don't know if that overrules all of those other things I was just saying. But this is still good for the bulls, but it becomes a target if this is a trading range. So 5 high would become a target if this ends up being a trading range. And you can see we got a bull trend from the open and then basically a trading range. On a larger time frame, this is probably a spike and this is probably a channel. Let's look at like a 15-minute chart. Yeah, so spike and then channel. So really just a spike and channel bull trend day. But not the easiest bull trend day, and traded a lot more like a trading range day a lot of times. 11, follow through for the bulls, but one of the problems I was talking about was the bar 8 close. So we got back to the bar 8 close during 11, and you can see that's why we formed a tail on 11, was when we got back to that point, some traders started to sell. 12 is follow through for the bulls, but it's not able to close above the moving average. This is good for the bulls, 10, 11, 12. It's going to be good enough for at least a second leg sideways to up. And it's a really tight channel, so the first reversal down will probably end up being minor. But I'm not really all that sure that we're going a lot higher with the tails on 10, 11, and 12. But we have already tested the magnet, which I think was the 8 close. So good for the bulls, but that we get 3 bars in a row. But disappointing for the bulls that we're not able to close above the moving average and close above the high of bar 8. Had 12 closed above the moving average and above the high of bar 8. It's a breakout attempt of what probably should have been converted into a leg in a trading range. 13, a bear bar closing near its low. It's possibly a wedge, 1, 8, 13, but I'm not probably going to sell that. If anything, if you're selling that, it's a scalp at best because, well, it's a good reversal down from the moving average, so it might be a credible scalp, but you're probably just going to get 2 legs sideways to down. You're probably not going to get some sort of big bear trend out of it. So difficult trade, I think. But I think a lot of bulls will definitely exit below 13. So it's credible, I suppose, if it triggered to take the sell for a couple legs sideways down, but it is a minor reversal. 14, you can see there were sellers above 13. So rather than selling below 13, a lot of times when you're sitting there and you're not sure if you should be selling below a bar, then sometimes it makes more sense to sell above the bar. But for 13 not triggering wasn't good for the bears. Bulls, they all had their orders to exit sitting right below 13. And so some other bulls bought the close of 13, causing 14 to rally. And that's really not ideal. The bears were hoping that they could trap some bulls out at least, or get run bull stops basically by trading below 13. And instead, bulls bought the close. So all the bulls are still in the market because of bar 14. And you can see we traded back down to the close of 13. Bears tried again to run the stops, but instead, any bear who sold the close of 13 was so disappointed with 14 that they used 15 to get out of their position around break even. Some bears who sold the close of 13 and got trapped sold more above 13 during 14 and used 15 to exit their trade. So it's really important that we never triggered below 13 during 14 or 15. That increased the odds that we were going to get some sort of rally. And then 16, a bull bar, but a big tail on the top, right? So it's not all that ideal. It's still always in long. It's kind of doing, what it basically did most of the way up, which is lower probability of a rally, but we just continued to rally. I thought this was going to convert into a leg into trading range, but instead we just continued to try to break out to the upside, which does happen sometimes. 17, follow through for the bulls, but a big tail on the top. So tail on the top 16, tail on the top 17. The bear argument is that we have a spike 5, 6, 7, 8, a pullback 9, and then 3 pushes up. So a wedge channel 1, 2, 3. And they want to sell below 17 for 2 legs sideways down. But 17 is a bull bar, and this is a really tight channel. So this is a pretty good buy below on 17. You can see a lot of traders took it. I think a lot of always in traders wanted to buy above a bull bar closing near its high. However, they're not really being given the chance to. Most of the traders are having to buy above, suspicious bull bars, up here, or you don't really want to buy above 8, even though it's a bull bar closing near its high, and you wouldn't have been able to anyways. So when that's happening and the market's continuing up, a lot of times traders just say screw it and buy below a bull bar like 17. 18, disappointing for the bears who bought below 17 or sold below 17, which is no surprise. Again, if you think about it from a perspective of the bears here, if you sold below 17, you basically know you're losing the trade. If you know you're losing the trade, it means we should go above 17. So now flip to the bull perspective. If you think about if you're buying, below 17 or something, you're expecting, or just in general with the market, you're expecting us to trade above 17 because 17 was a poor sell, and the traders who sell below there should not end up being rewarded. So if you go back to the bear perspective and you think about if you had sold below 17, what do you need to see for you to be happy and think that you're going to win the trade? You need to see a pretty big bear bar here, and basically as long as you don't get that pretty big bear bar, the traders who sell below 17 are not going to make money. And so that's exactly why we end up, you get disappointing bar on 18, and we end up getting another bull bar closing near its high on 19, and we break out above, or we're about to break out above that high. 20, a huge bull bar closing near its high, but really climactic bar. I'm not really that sure I want to buy up here. Again, it might be one of those areas where it's better to buy below. Look at all the climactic bars today. Where was it better to buy? Above them or below them? Climactic bar 8 didn't trigger above, traders bought below. Climactic bar 20 didn't trigger above, traders bought below. So what did you think was going to happen on 29? Climactic bar, and it triggered above, but we're way above the moving average. Probably smarter for traders to look to buy below instead. So 21 trades below 20. We find buyers below 20, which is not very surprising considering how strong this has been. This is it's an attempt at a wedge of some sort, 1, 2, 3, or 1, 2, 3. You got to keep in mind that on bull trend days, the market is constantly forming wedges that fail. So this could be a bull trend day, and you're looking for the bears, constantly looking for wedges, and they're not really going to end up being all that great. 22, a bull bar closing near its high. Do you buy above 22? I think you can, but it's a swing trade. I'm not, I don't love it. I would rather wait for follow through and then see what you get. But I thought you could buy above 22. It is a credible swing trade. Again, it is an IOI, and the IOI on 8, 9, and 10 worked. So it's reasonable to think that the IOI on 20, 21, and 22 will work. Something to consider is that when you get these sorts of patterns commonly, you can see we got 3 of those IOIs today. 4 technically, you count 39, 40, 41, which it was one as well. It failed, but it definitely counted as one. When you get 4 of those patterns this early in the week, we're probably going to try and get a couple more of them later in the week. So if it's, I don't know, Thursday or Friday or something, and you see an IOI, swing trade essentially, when you think about earlier in the week, the market has memory, so it'll remember that those trades worked earlier in the week, and it might slightly increase the probability of that trade that you're taking later in the week working. 22 an inside bar, bull bar, probably 40% chance that you're gonna, get a swing up here. It's not really all that great, but it's reasonable to buy above 22. I think it's better than buying above 10, but it's a similar idea that you're betting on a bull trend. But the channel up is pretty tight. If you're taking the buy, you're hoping for a breakout above the wedge and maybe a measured move up, which we do end up getting over here. Surprise for the bulls on 23. Additionally, if you're buying above 22, you did not want to see the gap down, the micro gap from, well, my buddy is telling me I call those micro gaps, but Al calls them tick gaps. So you can call it whatever you want. But as long as you know that when you see 23 open, it's a gap down, meaning traders sold the close of the bar. That should tell you what you need to know. So not as ideal as it could be, but you end up getting good follow through on 23 anyways. And 23 closes above the bar 20 close, which is really important. It shows that the traders who bought above 20 or about the close of 20 did not feel trapped by 21. Instead, they saw 21 and they probably just scaled in lower, and they're willing to hold on to their longs. So 23 inspires confidence for the bulls because it closes above the bar 20 high. 24, more follow through for the bulls. We're getting pretty high up though. This is probably turning into an area to more start to scalp trades rather than swing them. Swing trades are here and here when you're hoping the bull trend is just going to turn into a bull trend, but it has turned into a bull trend at this point. So you can buy above 24, but it's probably more of a scalp. And you actually probably would not have gotten filled trying to buy above 24. I don't know, whoever was watching today, but 25, in basically the first 5 seconds of the bar, went up to about where it ended up closing. So in the first 4, or maybe even less than that, it might have been the first second or two, I tried to buy above 24, but I wasn't fast enough. It moved really quickly. So some urgency there. Traders bought, and we got a good bull bar, but a big tail on the top. So some traders scalping with 2 or 3 points. Buyers below 25 after 4 straight bull bars, so you'll probably get at least a little bit of move up. And again, think about it this way. The traders who sell below bar 25, are they going to make money? No. So when you're not surprised when you get the doji bar 26, and where's 27 trade? 27 trades above 25, because just do the opposite of what a bear would do there. You got to think of it again. Think about it from the bear perspective. If you're selling 25, you're punting money. So buying below 25 and putting a limit order to take profits above 25 seems to be a logical thing to do. You can see on 27, we filled a lot of those orders, and that's why we found some selling pressure with the tail on the top, and then 28 started to sell off a little bit. Additionally, 26 was not a very inspiring bar for the bulls. It was a doji bar, meaning the buy the close was probably going to come to an end relatively soon here. So it made more sense that we were probably going to end up going sideways rather than straight up. 29, a bull bar closing near its high. It's a huge bull bar. It's really climactic. It's tough to buy up here, I think. And with the climaxes earlier turning into IOIs and better buy belows than buy aboves, I think it was better to take the trade below 29 than above it. An inside bar 31. We are always in long, and this pattern has worked twice today, but I'm not really all that in love with it. I think we're up really high in what's probably going to start to go sideways here. We're headed towards the middle of the day. 32, another inside bar. So consecutive inside bars, probably forming some kind of final flag. You can be long, but it's really not all that ideal. And then a bull bar closing near its high, 33. So again, it's okay to be long, but these are not really great trades. I think if you're buying up here, what are a lot of traders doing? They're scalping with 2 points. You can see they made exactly 2 points. So they bought above 33, they got their 2 points, and they exited. Traders are not thinking that we're going to turn into it, or we're going to end up getting a huge rally from here. The odds of that are pretty low. We're probably going to start to go sideways soon. So 34, a disappointing bar. And any trader who bought above 33 and was hoping 34 was going to be a big bull bar closing near its high is disappointed, and a lot of them will exit at the market, causing 35. Probably buyers below 34, but you're buying high in we're probably in a trading range starting at bar 26 Whenever you get the doji bar, it's a symbol that it's the start of the channel. And like I said earlier, channels are magnets. So we got a spike 22 through 25, and then start of the channel doji bar 26, and you can see we tested back to it. So if you're buying below 34, you have to realize we could easily test all the way back to the 26 low. So you probably have to have a pretty wide stop if you're doing that. 36, a doji bar. I think this is a tight trading range now. If you look, basically from 26 to 36, this doesn't look all that great for the bulls. It's still going up, but it's really not all that ideal. And the point being, in looking at the past 10 bars, is don't be hypnotized by how far up we've gone today. I think this is turning into some sort of final flag. Doji bars, consecutive inside bars, lots of patterns that could lead to final flags. 30, 37, a bull bar, but a big doji bar. If you set out of this whole trend and you're staring at 37 and you want to buy because you think we're still going higher, you should probably ask yourself, is this really all that good of a trade? If you missed all these trades, this is the one you want to take this late when it's probably, we have doji bars and we have inside bars. It's probably some sort of final flag forming. It's better to just wait and let it go at this point. Disappointing bar 38, but then a bull bar closing near its high 39, but it was a bad buy above 38. So we're probably going to test back down. If we do get a breakout above, it's probably going to be a breakout above a final flag, and we're going to test back into this area. And even if we sell off, we're probably going to test back into this area because this is so strong that it should get a second leg up. 40, we trade below 39, but we find buyers. So good for the bulls, but I'm not sure how much higher we're going to end up going here. We get, the best case scenario for the bulls is rally back to the 39 close. The bar 39 close is a magnet, however, since it was a bull bar closing near its high, and we were always in long in a bull trend. So it was probably reasonable to buy the close of 39. It wasn't great, but it was reasonable. So the traders who did that and scaled in know they're probably going to end up making money. 41, an inside bar. So an IOI pattern again, but that's a tail. There's a big tail on the top. I'm not taking this. I think it's too late in you're buying towards the top of a final flag in a tight trading range. 42, another inside bar, so an IOII like we got. Again, all these names, it's really just breakout mode is what's important to hear here. So traders ended up exiting below 42. If you notice, you never really had to exit if you were a bull. You could have bought above bar 4, and it was totally logical to hold the whole time until bar 42, where it's consecutive inside bars, and it probably just makes more sense to get out below. And that's what traders do, and that's why we get such a big bear bar with a huge tail, because traders are buying down here, right? No one wants to sell down here. Bears need quite a few bear bars in order to convince traders to sell. 44, a bear bar, but a big tail on the top and a tail on the bottom. So it's really not as good as it could be. And you can see we traded above 43. So probably sellers above 43 because bear bar and not a very good buy. It's basically a high 1, high 2 for the bulls, but not very good. Probably more buyers lower rather than higher. But again, with how tight the channel was up from bar 4 to bar 34, we're going to find buyers somewhere down here. So 45, if you sold below 44, you did not want to see 45. So a lot of traders are going to end up exiting. And 45 is a bear bar and it is follow through. But if you're taking a sell like 44, it's really sensitive and you need to see really good follow through rather fast. 46, a bull bar closing near its high, but it's really just a doji bar. Would you buy above 46? I would not buy above 46 because the channel down is really tight. However, I do think the traders who buy above 46 and put a measured move down, plus a couple ticks of 46, will be able to add on below 46. So what I mean is, if you took the buy above 46, put your stop and measured move down, plus a tick or two, so maybe here, or maybe another tick below, maybe a point below, something like that. Just not the exact, because sometimes it will go for the exact measured move and then turn up. But if you buy here and you put a stop here and you put an order to buy more here, I think the traders who do that are going to be able to get back to the bar 46 high. So it's a doji bar, and we're probably going to trade below 46, but I thought there would end up being more buyers below 46 than sellers. 47, disappointing follow-through bar. Big tail on the top, so a lot of bulls, they see that, they exit the trade, and then we get 48, a bear bar closing near its low. So two ways to manage the trade: exit up here or buy more here. The way to not trade this is buy above 46 and put a stop below. That is not a good thing to do. 48, a bear bar closing near its low. But again, I think, first off, 1, 2, 3. So it's some sort of wedge. There's a lot of ways to draw it. It's basically a wedge down. And with how tightly up this went, this is probably going to need some really good follow through for the bears to move down in any sort of good fashion. So if I'm going to sell here, I need 49 to also be a really good bear bar as well and really convince me the market's always in short. And that's probably not going to happen. As you can see, more buyers than sellers below 46. So traders bought more below. And we got a disappointing follow through. Sorry again. We got a disappointing follow through bar on 49 with a tail on the top and a tail on the bottom. Another inside, so an inside bar 50. I was looking for a bull bar near closing near its high to buy above, but I was more looking for some sort of trade the same way that 46 was, where you're looking to buy an add on below, because this is a relatively tight channel down and it's probably going to go a little more sideways first. And other than that, instead, sometimes you get a huge bull bar closing near its high, and that's enough. So for me, I saw 51, and now I'm thinking, well, this might be the start of the second leg up. So it's reasonable to buy above 51. Are you expecting huge follow through with 51? Probably not. So you're probably not going to get a ton of follow through, but it's a big enough bull bar to make the market back to clearly always in long. We're flipping to always in long, and it's it could easily still be a bull trend day or some sort of leg one, leg two day. So although buying above 51, we might go more sideways first. The premise that we're always in long and probably getting to at least the 39 close, if not higher, I think is valid. And you can see instead we got a huge follow through bar 52. And why did we get a huge follow through bar 52 and then sell off for 9 straight bars, something like that, or 1, 2, 3, 4, 5, 6, 7, 8, 9? Yeah, so 9 straight bear closes after bar 52. Why? Well, if you bought up a 51, you saw 52. A lot of traders are going to scalp a piece, right? So that's what's going to cause bar 53. Is a lot of traders, they buy above 51. They know it might go a little more sideways first, but they end up getting a huge bull bar 52, and they're able to make basically a quick 8 or 9 points. A lot of traders are just going to take that and call it a day. And some traders, what they'll do is they'll hold, hoping that we're going to end up getting a second leg up. They know that 51, 52 is strong enough for a second leg up. They know we're going to get it. So maybe they'll scalp a piece up here, but they'll hold a piece too, thinking that, okay, this is really strong and we might continue higher. 53 is a disappointing bar, but traders were probably somewhat expecting that. Again, they think 51, 52 is the spike, and we might get some sort of pullback, but ultimately they're betting on a channel. 54, disappointment, but big tail on the bottom, 53 and 54, so not really a sell to close kind of bar. But again, if you're a bear, if you're in a bull, as a rule of thumb, if you're in a bull trend, you never want to see a 3-bar pullback for the bears. And if you're in a bear trend, you don't really want to see a 3-bar pullback for the bulls, especially when it's like this, where it's so climactic on 51 and 52, and you need to start the channel phase. Bulls, what's going on up here is traders are waiting to see, is this going to be a spike, pullback, channel, or is this going to be a spike and then trading range? And bulls are hoping that it's going to be a spike, pullback, channel, but we need to start the channel within 3 bars. You don't want it. 53 was fine. You're assuming that's the pullback, and bulls wanted to bull close 54, but they get disappointed. But still okay to be long, but 55 needs to be a bull close. And it's not, it's a bear close. So when you get the spike and then 3 straight bear closes, what do traders do as we rally back to the bar 52 close? They say, well, I bought 51, I bought the close of 52. I was hoping we were going to continue to rally. But now we have 3 straight bear closes, and I didn't want to see that. So on 56, the rally up, they know it's probably not going much higher because the bears did too much damage with these 3 bars. So they just exited the trade, and that's what causes 56, the bear bar closing near its low. Or not near its low, but that's what causes the bearishness on 56. Follow through on 57, but I wouldn't sell any of the stuff here after 51, 52. It's probably reasonable, but it's just not really great sells. And then outside down, 58. Good bear bar, but we're getting near the bar 51 low, which there's going to be buyers there. And then a doji bar 59, so bad follow through. An outside bar 60. It's some sort of wedge. You could say 1 pullback, 2 pullback, 3, and then we end up getting a 4th leg down. But again, you could just say, 1, 2, 3 this way. You could draw the bottoms, and it's just a tight channel down. But after this bull spike, this is not enough to make me think that we're going to get a big bear trend. So 61, disappointment, doji bar. I was surprised that we did not test back to the 61 low, but you can see bears just gave up above 61, thinking that there were, look at how many buyers there were at the 51 low. It's exactly where we went to. We just rallied straight up from there. 62 and 63, so consecutive bull bars. It's a bull surprise. We're probably going at least a little bit higher, but I'm not sure how much higher. We might get back to the high of the day, but that's probably going to be about it. Then you get follow through 64, 65, so 4 straight bull bars. Good for the bulls. After the 4 straight bull bars, probably buyers not too far below, but after this, it's kind of hard to want to buy below bars. So middle of a trading range, lots of problems with everything, not all that great. Buyers below, you can see, and then outside up 67, but then a bear bar closing near its low 68. It's a wedge, 1, 2, 3, so something like this. The bulls want another breakout above the wedge on 69, and they're hoping for a measure move up somewhere up here, but I'm not too convinced they're going to get it. 69 could be a 3rd leg up too, so some bulls would say instead of 1, 2, 3, they would say it's more 1, 2, 3, first push up, second leg up, third leg up, and it's more of a trading range after the sell off from 53 to 61. So if it's more of a trading range after the sell off from 53 to 61, it's kind of hard to want to buy above 69. Big bar, big risk, high in the trading range. Did break out above the 52 high, which is good for the bulls, but not ideal. And when you get disappointment on 70, the traders do buy above 69. Look what they do. They use 71, the rally on it, to sell out of their longs. Reversal up 72, but no one's buying that. I think the damage is done. If we were going to go, we would have gone up on 69, and then we went sideways the rest of the day. For stop orders, I thought it was tough to get in on the bull trend, but you could have bought above 5 if you're aggressive. Probably 7 was fine. Again, a bit aggressive though. 10, swing trade, I still thought aggressive. 22, better, but still not excellent because 21 might get a second leg sideways to down. And then 23, buy the close, 24, buy the close. But again, it's not as ideal. You're getting pretty high up here, but probably buyers below. Better limit order trades in this trend, honestly. Buyers below 17, buyers below 25, probably buyers below 27, but a second reversal down, so not as good as buying below 25. I would not buy above 29. I wouldn't buy above 33, but if you do, you got to be quick to make decisions. I would not buy above 38. I would not buy above 46 unless you're using the wide stop, but 51 is credible, but you got to find a way to get out pretty quickly as it starts to sell off, or use the rally up on 56 to get out. So a bit difficult, and then I would not take anything else. So not the best day for stop orders, but still some reasonable trades. So I thought, again, really thought interesting that whenever you get the reversal up from exactly yesterday's low or yesterday's high, it increases the chances that you're going to get some sort of move. An inside bar, so we have an IOI pattern on the daily chart, right? So we had a bunch of them today, and not so shockingly, we formed one on the daily chart. So kind of funny when the market does that. It forms all those patterns intraday and then forms the same one on the daily chart. So again, it's, the bulls see this as a pullback and we're in breakout mode and they want to break out to the upside, but I'm not sure this is going to be a great breakout to the upside. Things can be more sideways. So I wouldn't be surprised if this failed. Weekly chart, again, I don't think this is going to go very far above. I think the FOMC is going to, basically decide what this day or this week looks like. So not really any point in going over those just yet. And yeah, that's the day.